Hi, I'm Ant Joblin and welcome to Markets and Minds, the show where we break down big macro themes into simplified trade ideas. This week we're looking at whether now is the time to invest in emerging markets and why the answer to that might be yes. A piece of history was made this week when Goldman Sachs said goodbye to a term that literally helped to define the emerging markets, with the closure of its BRIC equity fund. The acronym BRIC, which stood for Brazil, Russia, India, China, was coined by Goldman's then global chief economist Jim O'Neill back in the year 2000. It was meant to highlight the economic potential within those four developing economies, although 2 decades on, only China has really lived up to its billing. The Goldman Fund isn't quite dead, however, and is being combined with another of the firm's emerging markets funds called N11, or the Next 11, to form a broader-based investment vehicle. So if Goldman's is adjusting its emerging markets exposure, should private investors be doing something similar? And if so, why? 2 other investment banks have weighed in on that subject this week. Firstly, we heard from JP Morgan's European quant team, who continue to push the idea of a rotation in the markets. But rather than a rotation from growth into value, they believe that a switch from consumer stocks and service sectors into producing and manufacturing stocks is warranted. The bank points to data such as the ratio between new orders and inventories in the Institute of Supply Management, or ISM survey, which suggest that inventories need to be restocked. JP Morgan believes this is likely to support a prolonged rotation out of the US and Europe and into the rest of the world, as well as the beneficiaries of a weaker US dollar, which of course nicely describes the emerging markets, many of whom are exporters of the commodities, raw materials and primary goods necessary for inventory restocking, all products with prices that naturally benefit from a weaker US dollar. The equity strategy team at Credit Suisse also put pen to paper this week and highlighted emerging markets as their highest conviction overweight. The bank favours areas such as Thailand, South Korea, Brazil and India, but has reduced its exposure to China. The team at Credit Suisse believe global GDP will grow by 4% in 2021 and that the dollar will remain firmly in a bear market throughout the year. US currency weakness is supportive of higher commodity priced goods, which are vital exports for many emerging market economies. The trade-weighted dollar has fallen by almost 7% over the last 6 months, helping to boost emerging market equities and boost them very nicely. For example, the iShares Core Emerging Markets ETF has rallied by 32.2% since late May, compared to gains of 21% for the S&P 500 during that period. Our proprietary search tracking tool, Trackstar IQ, shows Wall Street investors are starting to warm up to emerging market ETFs too. If we're going to see an extended period of dollar weakness across the year end and into 2021, then the outperformance of emerging market stocks may well continue. And if that's the case, then more institutional money won't be far behind. Interestingly, fund managers who manage $526 billion were recently surveyed by Bank of America, who reported that 42% of the group believed that the dollar remained overvalued. They added that allocations to emerging markets were at their highest since March and had had the biggest one-month rise since April 2017. The smart money on Wall Street certainly seems to like the emerging markets, and it will be interesting to see if retail investors feel inclined to market that journey with them. That's all we have time for this week. To find out more about our Trackstar IQ data, sign up to our free newsletter at investingchannel.com/Trackstar. Remember, make sure you do your own due diligence before making any investment decisions.